Late payments? Many businesses have faced clients who are guilty of this. But how much do they really affect your bottom line? A recent survey across Asia showed that nearly half of all B2B credit sales are delayed. And guess what? Singapore, Hong Kong, and Taiwan are among the top of that list. If you want to avoid that, you need to manage your accounts receivable properly. But what exactly is accounts receivable? Also known as AR, it represents the amounts owed to your business for products or services delivered on credit. It's considered a current asset on your balance sheet. Basically, it's future cash that hasn't arrived yet. On income statements, revenue is recognized when you make a sale on credit, even before payment. Meanwhile, in cash flow statements, changes in the AR impact the operating cash flow. So what's the difference between accounts receivable and accounts payable? Generally speaking, AR is the money owed to you, while AP is the money you owe. To be considered a healthy company in Singapore, you should have a higher AR than AP, ideally with a 2.1 ratio. So how you achieve that? The first step is to know the accounting standards for managing ARs. The first standard is the Statutory Board Financial Reporting Standard, or SBFRS 115. This regulates how revenue is recorded. Second is the IFRS 9 for measuring potential losses and uncollected amounts. Third is the expected credit loss model for estimating bad debts. The next thing you should know is the different types of account receivables. Trade receivables is the money owned for your goods or services. Non-trade receivables are amounts indirectly owed, like interest and reimbursements. Notes receivables are debts backed by promissory notes. Last, we have installment receivables, which are fixed payments to be made over a period of time. Now let's learn how to process AR properly. First, always check a customer's credit history before offering credit. Second, be sure your invoices are done clearly and professionally with all the required details. Third, make sure all credit sales are recorded in your accounting system. Fourth, once a payment has been made, match them to their invoices so your records are promptly updated. Fifth, have a systematic approach with overdue payments. For instance, you can separate accounts into those that are 30, 60, and 90+ days late. You can then prioritize those that are the most overdue. And finally, do send periodic reminders and follow up with calls on non-payers. See if you can reach an agreement on how they can repay your business. Now, if you want to be more effective at invoicing, keep these tips in mind. Number 1, be clear and concise with all the terms in the invoice. Any ambiguity can lead to payment delays and disputes. R2, if you're using terms like net 30, you may want to specify them so the customer can understand. 3, find ways to encourage clients to pay on time. You could include Pay Now QR in the invoices for easier payments, or discounts for early payments. And don't forget to specify the charges for late payments. Lastly, you should also keep track of your AR metrics too. For example, Day Sales Outstanding measures how quickly you collect payments. The AR turnover ratio shows how efficiently you convert receivables into cash. Meanwhile, Bad Debt Ratio tracks the percentage of uncollectible debts you have. Managing your accounts receivable can seem challenging, but it's key to running a successful business in Singapore. With the right strategies, you can get paid on time and improve your cash flow. And remember, Corporate Services Singapore is here to help if your business struggles with its accounting. Contact us anytime if you need an expert's touch with your finances.